If you're like most business owners, you're consistently looking for ways to protect your assets and reduce your taxes. Many business owners believe that reducing their taxes is something that the ultra wealthy are privy to do, and also believing that they do not have enough valuable things to protect to avoid what wealth they have from being taken by high attorney fees and other court costs, or even worse, the death tax. Well, in today's video, I'm going to show you how only 3% of business owners are saving thousands of dollars in taxes while protecting their business assets using LLCs. But make sure you stay until the end of this video, because in this video I'm going to share with you 2 legal loopholes that you can use to reduce your LLC taxes while protecting your assets. So without further ado, let's get started. Many business owners today are familiar with the process of setting up their LLCs. However, a majority miss out on the opportunities that come with tax savings and asset protection. Let's start with what an LLC is and why it's the most popular structure in today's current tax and legal environment. So, an LLC is known as a limited liability company. The statute was created in Wyoming in 1977, and the LLC entity allows unincorporated businesses the freedom from personal assets being consumed by business debts or other legal matters. So think of the LLC like the first layer of insurance offered by your state that you're registered to do business in. One of the greatest and oldest advantages of having the LLC is that your risk is limited to the amount of cash or property that you contribute to your business, the same like as a corporation. The LLC has the corporation's protection components within its entity characteristics, while also allowing you to avoid double taxation whenever you decide to withdraw money from the business. So for example, if 2 people go into business, right, and in the state that they register, that state is going to automatically generalize them as a general partnership. So general partners are 100% personally liable for anything going wrong in that partnership. However, if you register as a limited liability company, you get to keep all of your business transactions pretty much separate, where it avoids from personal assets being hit by business liability. So now, imagine what you could do with this type of legal protection. To best protect your assets is to just list out the most valuable things about the assets that you have, and then we'll wrap them around an LLC. So for instance, maybe you're considering purchasing your dream home that you want to move into one day when you retire. You want to make sure that this home is well protected against yourself and other assets that you own, like other rental properties, businesses, cryptocurrency, stocks, etc. Now, while trying to protect this home, you simply want to wrap your home within a legal structure. There are other structures that you consider as well. You may be wondering, how does this help me reduce taxes? Isn't an LLC income subject to the additional 15.3% tax? You're absolutely right. If your income is generated by a trade or business, and you're the one who's making the decision, and you control every aspect of that business, then this is going to push a 15.3% tax on the earnings that you receive. Now, how do we effectively use the tax code to reduce the additional 15.3% tax? Having an LLC already established opens the tax code to your advantage to use certain loopholes to save in taxes. The first loophole is depreciation. Depreciation is like magic. For example, you purchase an item for your business that may cost you $100,000. However, you finance the asset at $90,000 with a cash down payment of $10,000. Well, the tax code allows you to depreciate the entire $100,000 at 60% of the cost, and the remaining is expensed over a period of time. Now, your out-of-pocket expense was only $10,000, real cash. However, you're allowed to expense the item at $60,000. This section of the tax code significantly reduces your taxes to a reasonable amount where you're not overpaying Uncle Sam. The second loophole is hiring your family members. This is a way to income shift to your children or parents who are in a lesser tax bracket than you are. This strategy allows you to take your income that's taxed at 37% and move it over to like your child who's in a 0 to 10% tax bracket without having to pay into Social Security and Medicare taxes. You'll want to speak with a tax strategist to get the specifics on how you're eligible to do this before actually trying these strategies on your own. Millions of business owners are looking for more ways to save in taxes and to do so legitimately to protect their hard-earned wealth. If you'd like to learn more about how these loopholes that I shared in today's video could work for you, book a call with one of my team members and they will gladly guide you on how these loopholes work. You can also visit our website where we have blog articles informing you about the latest tax saving opportunities for you and your business. With that being said, see you next time.